You've heard it to death. Interest rates have been rising faster than a Tory's blood pressure.
Today's news is going to be very tough for families with mortgages.
All in an attempt to curb our runaway inflation problem.
And it's doing it because they believe the situation is very grave.
Most recently, on the 3rd of November, we've just had the single biggest rate rise since 1989, with the move seeing the Bank of England base rate go from 2.25% all the way up to 3% in one single swing of the monetary bat.
This is the 8th consecutive increase in bank rates since December of last year.
And what this 0.75% increase means, slapped on top of the other increases we've already had, is that mortgage deals are getting more and more expensive.
They will rise more. We can expect further interest rate increases.
So is now the time to fix your mortgage deal? Maybe even come out of your existing deal early, suffer the early redemption penalties to get yourself a deal now before they inevitably get a whole lot worse. Or maybe it's time to get yourself a variable deal, avoid those higher rates of the fixed rate deals. Is it time to remortgage now before it's too late? What's this? Ooh, one more question apparently. And is it time for Tom to get a haircut? Yeah, very funny. All good questions, let's answer them. There's no one there, by the way, I'm just pretending. There's not even anything on this piece of paper. Ladies and gentlemen, Hollywood. There are loads of different types of mortgage products. Some pay down the capital, some only cover the interest. You can get capped rate deals and discounted variable rates, to name but a few. But before you get bogged down in the financial industry's best efforts to bamboozle you with jargon, just know this. The interest rate on every single mortgage is either fixed or variable in one form, shape or another. And no, Tom is not cutting his hair. Ooh. Fixed rate mortgages means you locked in the interest rate that you're paying for a specific time period. And regardless of what wider interest rates do during that time period, you are protected from those and you know what you're paying. If rates in general go up and mortgage deals get more expensive, a fixed rate deal looks like a smart move. If, however, rates come down in general, then you're now fixed into paying a higher rate than is now the new going rate. Either way, the reason these types of products are so popular is actually the security and peace of mind it gives people knowing what they're going to be paying each month so they can budget accordingly. Variable rates are a different beast entirely, and this is what you'll naturally fall onto after your fixed rate deal comes to an end unless you agree a new deal with your lender. Every single lender has something known as a standard variable rate, or SVR for short. Now this is where a lot of people get confused. This rate isn't in fact directly linked to the Bank of England base rate, though it is the primary influence on what makes them go up or down. Usually when the Bank of England base rate goes up, so do lenders' standard variable rates. And it makes sense, doesn't it? It just got more expensive for them to borrow money from the central banks, and naturally they're going to pass that on to you as the end customer. Mwah! Capitalism. Around 74% of people are actually on fixed rate deals. That's about 6.3 million of us. And as you can see from this graph, since 2010, their popularity has been increasing exponentially. In fact, since 2019, around 96% of people have chosen a fixed option instead of a variable deal. So what this in fact means is that most people are in fact protected from these rate rises for now. And there will be a somewhat delayed reaction. It won't be until people's deals start to come to an end and they realise that they're fishing in a much more expensive pond for a new deal. According to this study from the FCA in August this year, around 37% of borrowers have deals ending in the next 2 years. So it could get interesting from here for those people. And I'm included in that list. But in the meantime, for the 2.2 million of you that are on variable deals of one form or another, these rate rises are a very real issue for you right now. Around half of you 2.2 million people are on trackers or discounted rate deals, so you'll be paying a little bit less than the standard variable rate, and the other half of you are in fact on the standard variable rate. A tracker directly follows the base rate, so your deals are going up now if they haven't already. Sorry to be the bearer of bad news. The news is a little better if you're on the standard variable rate because they actually move at lender's discretion. Although, let's be honest, if the base rate goes up, so does usually the standard variable rate. Although, not necessarily by the full 0.75% increase that we've just seen. I actually have it on pretty good authority from a few lenders that they are about to increase their standard variable rates again as of the 1st of December, so brace yourselves. So you're either on a fixed rate deal with some time left, or one that could be ending very soon, or with a number of years left to run. Or maybe you could be sat there on a variable rate and could be feeling the effects of these changes right now. Why it's important to try and make the distinction between these two types of mortgage is that in order to answer the question, should I remortgage now before it's too late, it really does depend what type of deal you're on right now. Now, this isn't financial advice, and I would urge anyone considering any action at this point to speak to a mortgage advisor to help navigate through this minefield. But what I will say is it's far more likely that it might be worth considering a fixed rate deal if you're on a variable one right now. That being said, it's not the case that absolutely everyone on a variable rate should be rushing out to fix now. And if you're on a fixed rate deal right now, it might just make sense to sit tight and see how this one plays out. Here's why. Fixed rate deals come with early repayment charges, and they usually look something a bit like this on a 5-year fixed, for example. 5% in the first year and then falls on a sliding scale as you move through the 5-year fixed period. So if you're on a fixed deal, you will almost certainly be hit with a bill to get out. That's a known cost, a known risk that you're taking in the hope that you get the other side of the equation correct. And I know a lot of you will be watching thinking, yes, Tom, but this is only the start. Inflation is still out of control. Interest rates are only moving in one direction. The deals are just going to get a lot worse, so it's worth taking a hit right now. Well, you say that, but look at this. 2-year fixed deals with a higher interest rate than 5-year fixed deals. That's interesting because it's usually the other way round. You usually pay more for the peace of mind of fixing for longer. But right now, it's the reverse for some lenders. What does this tell us? It tells us that lenders are making it more attractive for you to tie in for longer, or in other words, they think their rates will actually be lower in 5 years, not higher. This all comes down to the fact that they overreacted to the mini budget and hiked up their rates, probably unnecessarily in a reaction to it. And what we've actually just seen is, although the base rate's gone up by 0.75% recently, fixed rate mortgage deals actually stayed the same, or in some cases actually fell slightly, because the previous hikes were overdone. After Kwasi Kwarteng's ill-fated mini-budget went down like a fart in a spacesuit, the average 2-year fixed deal went from 4.74% on the 23rd of September to 6.65% by the 20th of October.
That is how we will deliver higher wages, greater opportunities, and crucially, Mr. Speaker, fund public services.
On this very same day in October, financial guru and everyone's mum's favourite heartthrob, Martin Lewis, said this: "Warning, fix your mortgage if you want certainty, but you could end up paying more than you need to." And I think he'll be proved right. He points out that deals aren't in fact in sync with the base rate, and this was highlighted by the fact that no sooner had Kwasi popped his papers down to lenders hit the panic button immediately. However, now that things have calmed down a bit and Liz and Kwasi have shuffled off presumably to some Caribbean island in the hope no one recognises them, what we've actually seen over the last few weeks is some lenders starting to trim their fixed rate deals. What had happened is lenders had already priced in a pretty chunky rate hike, and it's something called money market swap rates that largely determined the pricing of new fixed rate deals, and these have been coming down in recent weeks. All this has led to the rather strange phenomenon of base rates rising but fixed rate mortgage deals staying the same or falling slightly, and is a great reminder of just how quickly things can change. In this article by the FT, it says lenders state fixed rate deals will come down, but it will take time. Not everyone has time, of course, but as detailed earlier, many of us do in fact that are currently sat safely on fixed deals. But what about the impending housing market crash that this is of course all going to create? We've all seen the headlines and seen their YouTube videos telling you about the impending housing market apocalypse. If you keep on reading and watching, you're going to be convinced that before long, you and your extended family will be huddled around a fire in a cave fighting over a solitary piece of rat. ITV call that entertainment.
Yes, you naughty boy.
Every quarter, the Bank of England issues a monetary policy report, and I'd be lying if I said they were real page-turners, but the latest one confirms the UK housing market has been strong, but momentum appears to be easing. Not, in fact, talking about a complete collapse like other tabloid sensationalists, but still acknowledging that the tide is turning on housing and the juggernaut is starting to slow down. Since that report, things I think have got a little bit worse, and the sentiment does seem to be that house prices may come off. I've read lots about 10% falls for 2023. But remember, this is all guesswork, and bad news sells newspapers. The challenge here is the effect this could have on our loan-to-values. Let's say you own a house worth £200,000 with an existing mortgage of £160,000. That means your loan-to-value is 80%. Let's say house prices do crash by, say, 15% and your house is now only worth £170,000. Your loan-to-value is now 94%, and that means you are a much higher risk to lenders, and as such, all the deals that are going to be available to you will be a lot more expensive. This could leave people restricted to their current lender's deals, or even worse, trapped on a standard variable rate, struggling to find a new deal at all, which is not a good place to be. For example, if you've got a mortgage for £150,000 over 25 years, and let's say you're used to paying an interest rate of 2%, if that moves up to, say, 6%, you're staring down the barrel of an increased monthly payment of £330 a month. And the deals could be even worse than that if your loan-to-value has pushed you into those more expensive brackets. There's a decent calculator on the BBC here, I'll leave a link in the description, where you can play with the numbers and see how things might affect you. It's better to be well informed and test your finances to see how you'd cope. The best way for me to summarise everything at the moment is, it's uncertain. I've talked a lot of if, buts and maybes and guesswork and things that might happen in this video, and for good reason, because I've got no idea. I'm just offering my best guesswork and commentary like anyone else. And I think very often when things are like this, the best thing to do is in fact nothing at all. As I mentioned earlier, I'm actually on a fixed rate deal at the moment. I actually reminded myself of the rate the other day and felt like an old man reminiscing about the good old days. I'm certain I'll be paying more in 18 months' time when it comes to remortgaging. But I'm not jumping ship now and paying early repayment penalties for the privilege. I'm just going to sit tight, wait until that deal runs out, and then play my cards at that point. What I am going to try and do in the meantime is save a little bit of extra cash so I can lump it off the mortgage if I'm able to, and I think that's appropriate at the time, just to make sure I give myself the best chance of the best deal that I can. If you're on a variable rate now, it's a bit more unclear. Is now the time to fix? It's really hard to say. It looks like deals got far too hot and are in fact calming down, but I also think the base rate is moving on too, and there are likely further increases. Best predictions suggest now the base rate might get up to 4–4.5% next year. If that's the case, fixed rate deals are likely to increase further still. And if the full rate increases up to that 4–4.5% are passed on in their entirety, we're going to be looking at fixed rate deals of 6–7% easily. Maybe 8% say for 5-year fixes, which is a lot more expensive than they are right now. But as I say, this is guesswork at best. What I would say is it's far more likely that you should be considering a new deal if you're on your lender's standard variable rate, because it doesn't get much more uncertain and expensive than that. So it really is a tough question to answer, and I think in a lot of ways comes down more to how well you'd sleep at night. If you're sat there on a fixed rate deal now, I say sit and wait it out. But if you're on a variable rate deal and you would get genuine peace of mind from fixing now, and that's more important to you than the fear of missing out you might feel if rates do in fact come down and you're stuck on a higher rate, then it's definitely worth considering fixing now. And quite frankly, how likely an impending house price crash is another question entirely. Something huge has been happening in the housing market for years anyway. Oh, look at that. Got another video on it. Just when you thought you were finished. Leave me a comment on the video. Tell me what you're doing with your mortgage right now, and I'll see you over there.